ACCA Masters. My name is Athraziz and I am your teacher for this course. It is our first lecture on financial management. Let's start with seeing the difference between financial management, financial accounting, and management accounting. Okay, so first of all, let's see what is management accounting. Using management accounting, we can compute cost of several products, departments at different stages. So it provides the useful information for day-to-day decision which assist management for making decision. And there are no strict rules for making or for computing these costs. Whereas if we talk about financial accounting, then in financial accounting we have several standards, IFRS in place, and we have to prepare our accounting books according to the given standards. These transactions give information about the past event and we can see a big picture of the whole business by seeing the or by reading the accounting books, right? Now, if we talk about the financial management, then financial management looks at long-term raising of finance and control of resources. Let's see these things in more details. It is our first chapter of financial management and its name is the financial management function. In this video, I will brief you this whole chapter. Let's continue. Okay, so if I talk about a company, then every company have any mission statement, right? And in this mission statement, company describes its objectives, that why the company exists, what they want to achieve. Okay, everything is mentioned in this mission statement. So company clearly describe its objectives in its mission statements. Now to achieve these objectives, the company obviously needs some finance so that they can invest into the company to run its operations smoothly. Now here we have a financial manager, and as a role of financial manager, he has to take decisions related to investments. For example, there can be number of projects, project number 1, 2, 3, 4, and so on. He has to take decision that which investment is more suitable, and these investment decisions should be in line with the company's objectives. Okay, he has to take decisions related to the dividends. For example, they take decision that either to distribute these dividends among the shareholders or not. If yes, then how much dividends they should distribute among the shareholders and how much they should reinvest into the company again. Okay, because it can directly affect the value of business and its ability to raise further finance in future. These are two major sources of finance. And here we have one more important role of financial manager, that is related to working capital. For example, it's related to the day-to-day requirement of finance which is needed by the company. But it's related to short term, okay, and it's related to management of liquidity of the company. Okay. So it means the investment decisions can be short term and long term. Now we have an other concept of shareholders wealth maximization. Almost every organization has an objective to maximize the wealth of their investors. And here we have a strong argument in the favor of this statement. When somebody take decision to invest or to buy shares of any company, then they take some degree of risk, and as a result of taking this risk, they should be given premium in sense of maximizing their wealth, whereas they could also invest in the risk-free government securities. But they are not investing in risk-free government security. Instead, they are investing in any company, so they are taking some degree of risk. So as a result, we can argue that it should be the primary objective of every company to maximize the wealth of their shareholder. It is very important here to distinguish and remember that shareholders' wealth maximization is different than the shareholders' profit maximization. These two are separate concepts. There are many problems associated with this profit maximization concept. Let me tell you. In order to maximize the profit, a company can take any strategy, a company can adopt any strategy that can result in fall of share price. For example, in order to maximize the profit, a company can simply cut down some of its expenses like marketing expenses, like R&D, search and development expenses, training expenses, and so on. So in this way, company can maximize its profit by reducing or by cutting down its expenses, right? But this tactic can easily be identified by stock market, and as a result the share price can fall. Now this share price may also fall by another concept which is known as poor quality earning. According to this concept, a business take high risks to achieve high profits. Now the stock market will refer it as poor quality earnings. And now what will happen? The risk averse kind of shareholders, risk averse, can simply sell the share of such a company because they may think that it is highly risk company. So they may simply sell their share, and as a result the price of share will fall. So these are the major problems which are associated with the concept of profit maximization concept. A company can also measure its success using EPS, earning per shares. It is PAT plus preference dividend divided by number of shares issued. Using it, we can measure the return to equity. But it carries the same criticism which rests with the concept of profit maximization. Because using EPS, no doubt we can measure the return on equity, but it does not measure or it not represent the income of shareholders, right? Instead, it only represent investors' own share of income. For example, it's the income of shareholders, right? But this concept only measure the small portion which is associated with the investor's own share of income. So it is an other drawback of using EPS. Now we have some more concepts that we should know. Here we have a concept of maximizing versus satisficing. Maximizing versus satisficing. According to the concept of maximizing, a company tries to achieve higher return by exposing itself to the higher risk, and obviously it will also increase the workload of management. On the other hand, according to the concept of satisficing, a company tries to hold returns at satisfactory level, and also reduce the workload of management. Now we have an other important concept of stakeholders. Stakeholders are those who have vested interest in the company. For example, it can be employee of the company, they can be directors, they can be shareholders, they can also be the banks of the company. For example, they are interested in lending loans to the company, right? And similarly, they can be customers, they can be your suppliers, and they can be even government, because government is also interested to know that how much tax they can collect from you, and for many other reasons, for example related to import and export. And in this group, and there can also be general public or community at large. Now, as a role of manager, a manager should balance between the need and objectives of all stakeholders. For example, in case of high returns, the employees of the company or trade union may claim for higher wages or higher salaries. Now, a conflict of interest may arise between employees of the companies and the shareholders of the company. For example, in order to satisfy employees, provide no more than adequate returns to the shareholders. So, as a role of manager, a manager should balance between the needs and objectives of all the stakeholders, and it was one of the example. Now we have another concept of agency theory. In agency theory, we have two parties. One is principal and the other party is agent. For example, the principal can be the shareholders of the company and agents can be directors of the company. Now it is a relationship where one party, principal, in this case we talk about shareholders, employees, and other party, for example the agent, the directors, to act and perform tasks on their behalf. A conflict of interest may also arise in this theory. For example, the directors may try to maximize their remuneration instead of maximizing the wealth of shareholders, right? For example, they can falsely increase their remuneration, their bonuses, and ignore to maximize the wealth of shareholders. So the conflict of interest may also arise here. Now to resolve this risk, we can inline the reward of directors with the wealth of shareholders. For example, if the wealth of shareholder will increase, accordingly the reward of director will increase. So there are some suggested solutions for it. For example, link the rewards with the minimum level of profits. And other suggested solution is EVA. EVA stands for Economic Value Added. We will see it shortly. And another solution for it is revenue growth. And here we have also another solution which is known as ESOP. ESOP stands for Executive Share Option Scheme. All of these suggested solutions have their own pros and cons. Now I am going to clear this screen so that we can see them in more details. Okay, so we were talking about agency relationship or agency theory. Basically, this relationship exists between two parties. The first one is known as principal and the second one is known as agent. Our principals are shareholders of the company and agents are directors of the company. Now these shareholders appointed these directors to work on their behalf because the shareholders cannot involve into day-to-day operations of the company. So that's why they have appointed some directors so that directors can act on their behalf. And as a fiduciary duty of directors, they must have to work in the best interest of the shareholders. So it is their moral and fiduciary duty to work in the best interest of shareholders. This relationship can also exist between any other party too. For example, it may exist between the employee and manager of the company. It may exist between employee, manager, and customers or supplier of the company. But the most important relationship is between the directors and the shareholders who have invested in the company. This is the most important relationship. Till now, everything is fine, but the problem arises when the directors do not work in the best interest of shareholders. Instead, when they work in their own their own best interest. Okay, so when they start to work at their own best interest, then at that point, conflict of interest may arise. Now, to solve this conflict of interest, we have different options. For example, minimum profit level, for example, EVA, for example, revenue growth, and in the end we have ESOP. Fine, we will see it later. But right now, let's start with minimum profit level. What if we associate the remuneration of directors? According to this solution, we try to link the remuneration of directors with the profit levels of the company. For example, if the profit of the company will go up, if the profit of the company will go up, only then the directors of the company can get more remuneration or bonuses. So it is the concept behind it. But it also have some drawbacks too. For example, the directors or managers of the company can simply manipulate the numbers or figures to show false profit levels. Fine. So the directors and managers can manipulate the numbers, and by manipulating they can get more reward, they can get more bonuses. So it is one of the major drawback. And other drawback is it is more focused to short term. Managers may try to gain or to make more profits in short term, and instead they may sacrifice the long term profitability of the company, right? So it is an other drawback of it. And one more drawback that we have is the manager may simply stop working when when they feel that they have achieved minimum profit level as a target. So When they achieve some minimum profit level, they may stop working and get relaxed. Again, it may impact on the company's achievability. For example, a company could achieve more if managers couldn't stop at some specific point, right? So these were some basic problems with the minimum profit level. Okay, now if we talk about EVA, if we talk about EVA, then it is the abbreviation of economic value added. According to this concept, the director of the company can get more reward only when it works in the best interest of the shareholders to increase their wealth. But the problem is bonuses or reward calculation can be complex. Okay. Now if we talk about the revenue growth. According to the revenue growth, the manager will get more reward when the revenue of the company will increase. But again, we have certain problems with this method. For example, a manager or director of the company may try to sell a product which may increase the revenue, but on other hand, it is not profitable. So they are increasing revenue at the cost of profit. Fine. They can also do it by they can also increase the revenue, for example, by decreasing the sales price per unit. In this way, they can sell more number of units, but again, they will compromise with the profits of the company. So that were its major drawbacks. Now, if I talk about ESOP, then it is more detailed. So I am going to clear the screen so that we can talk about it. Okay, let's discuss about what is ESOP. ESOP. It stands for Executive Share Option Scheme. Now the company offered this option to their employees for a number of reasons. For example, to retain them in long term. It may also encourage the managers or directors of the company to work in this way so that they can increase the share price in long term. Let's start with an example. Let's say it's 1/1/2020 and at this date company or the employer agrees with employee that we will give you certain amount of shares. For example, we will give you 2000 number of shares, or we will give you the option of 5000 number of shares at certain period. Let's say that period is 2 years, so that is 112022. Now the commitment is if the employee will serve the company for 2 years, for continuous 2 years. Then after 2 years, we will give you an option to buy a certain number of shares. So at this date, they will grant an option. For example, you can purchase 5,000 number of shares or 2,000 number of shares. Now let's say the employee continue to work with the same company. Then after 2 years, the company or the employer will give a grant letter to employee that we are giving you the option to buy the certain number of shares, and this date is known as grant date. Now here is very important thing that on the grant date employee cannot buy these shares. Instead, the employee and employer will agree at certain terms and conditions. For example, if the employee continue to work for, let's say, 1 more year or 2 more year or 3 more year, etc., whatever decides between both of them, then they can exercise this option, not at this moment but at the later date. So this grant letter is a conditional paper. It is a conditional paper with some terms and condition whatever decides between employee and employer of the company. Let's say in these terms and conditions they have decided the 3 years period. Now at after 3 years, that will be 1/1/2025. After these 3 years, the employer will give employee an option to buy those shares whichever is committed between both of them. But only if he continue to work but only if he continue to serve for 3 more years or whatever the period is decided between employee and employer of the company. Now let's say the employee leaves the company after grant date at some point, then he will not have any option to buy these shares because it was a conditional papers with some terms and condition. So in order to buy these options, he must have to serve for 3 more years according to the terms and condition. Only then he can purchase that number of shares. Fine. Now again, it depends on employer and employee. They can decide any rate. For example, you may buy share at $5 at that date, okay, or they may also agree that you can pay only 50% of the market share, excuse me, or they may decide that they can pay only 50% of the market share, whatever the price will be at that day. The employee can only pay 50% or 40% of the market rate of the share market rate. Now this period from 2022 to 2025 is known as vesting period or informally as waiting period, because employee have to wait for 3 more years to exercise this option, waiting period. and the price at which employee and employer of the company agrees. That price is known as exercise price. Now let's say the employee continue to work for these 2 years and again he continue to serve for these 3 years. Now today is 2025, this date. Now employee have an option. Either he can buy or not. Fine. The option rests with the employee. He can buy or he may just simply refuse that he don't have money, he don't want to purchase for any other reason. So he may simply refuse. But the option remains with employee at this stage. And he will have to decide either he want to buy or exercise this option or not. Fine. Now one more thing. Employee have certain period in which he have to exercise this option. For example, it's a 1 year period, but if he don't decide anything within 1 year or within 2 years, whatever decides between in these terms and conditions, fine, let's say 1 year in this case. Okay, if the employee don't exercise or if the employee don't make any decision within one period, then this option will expire and then the employee cannot exercise this option anymore. So the employee will have to make any decision within this time, whatever decides between employee and employer in the terms and conditions. Now this period is known as, excuse me, now this period is known as exercise period. Now here we have some disadvantages of ESOP. For example, if at exercise date directors sell their shares for cash, then to keep their interest, company may have to offer more share options to them. And as we are offering more share options to the director, then it can lead to the risk of dilution of equity. Further, the directors of the company can simply manipulate numbers and figures to increase the share price and value of their share options.